Hello friends, this is CA Karun Nagpal. I am a registered valuer. As you all know that valuation is undergoing a lot of changes and valuation is gaining recognition. Our purpose is to have this video for the registered valuer, aspirants who are preparing for the registered valuer, or all the professionals who wanted to enter into this profession, because this is something it has just started and it is gaining the recognition. It came into picture when IBBI was drafting the insolvency and bankruptcy code. So for the resolution of the corporate person, they require the valuation of a business. So they developed the company's registered valuer and valuation rules, and under the Companies Act section 247, and they started registering the registered valuer. Now they realized that this will not suffice the purpose. Then they drafted the separate bill. They wanted to have a separate regulator for valuation. So they drafted Valuer Bill 2020 to have the associate valuer, or to develop the valuation as a separate profession. So if I talk about India, so it is at initial stage around 3,000 plus valuers have been registered. And if I talk about the international market, so this valuation market is well developed. There are valuation professionals and there are international valuation standards. So in India, it is getting regulated, because earlier it was unregulated and it is dominated by the engineers or chartered accountants, and that is why government is planning to have a separate regulator, which is National Institute of Valuers. So once the draft valuer bill gets approved, we will see that the draft valuer bill will have associate valuers. Currently, IBBI is governing the valuation profession, because IBBI developed the IBC. They developed the regulation under, and they felt the need of the valuation. So that is why they are regulating the valuation profession. They have come up with elaborate procedure how to become a valuer, how to become a registered valuer under the company's registered valuer and valuation rules. And once the NIV will be there, so these rules will go away, and then the NIV will take over, and there will be separate statute for regulating the valuation. So in this video, we will basically talk about the valuation. We will talk about the overview of valuation. So let us start. So as you can see here are the contents of today's video. We will talk about value, how it is different from price. We will talk about types of value, fair market value, intrinsic value and all. Valuation premise, broadly going concern, and liquidation are the valuation premise. We will talk about that in detail. Purpose of valuation, why valuation is required at all. Valuation standards, so there are international valuation standards and also valuation standards issued by ICI, so we will talk about that. Valuation process, we will talk about the entire process, how valuation to be done. Valuation report, how valuation report to be issued, its documentation, and why documentation is important. So let us start with the famous quote from Warren Buffett. If you do not know Warren Buffett, he is one of the most successful investor in the world. I hope everybody know Warren Buffett. So he says, price is what you pay, value is what you get. So as from the definition, you would be able to understand the price and the value are two different things. So he applied this particular definition in all his investment decision, and he was able to achieve the phenomenal success. Now let us understand the difference between value and price. Price is money paid to get something, whereas the value is the worth of a particular asset or commodity. Or value, we can say that it can never be determined in terms of money, because it varies from customer and customer. Price is determined by the market forces, demand and supply of the commodity or product. And we can say price is arbitrary and value is fundamental. So let us quickly watch a very nice video clip to understand the difference between price and value. Friends, I hope now you were able to understand the difference between price and value. Now, types of value is fair value. Fair value is defined as the price that we receive to sell an asset in an orderly market between market participant at a measurement date. So this is defined as per Ind AS 113. I have uploaded another video on Ind AS 113. Do watch it. So here we can understand that when a transaction is happening between the knowledgeable buyer and the knowledgeable seller and they are willing to enter into a transaction, that would be regarded as the fair value of particular asset or business. And the fair market value is the price which is undergoing in the open market. Then we have the intrinsic value. Intrinsic value is the worth of an asset. So arrived at by factoring in both tangible and intangible factors. So it may not necessarily be the net worth of an asset. So there may be intangible assets which are not in the balance sheet that would be included to arrive at the intrinsic value. Investment value is the purchase price. When you buy something, you pay money, so which is called as an investment value. Synergistic value is arrived by using the combination of two assets. For example, printer and cartridge. So we have two assets, printer and cartridge. They are separate, but they cannot be used separately. So they have to be combined together to be able to put to use. And this combined value, they both have the combined value and they cannot be used in isolation. They are useless if we say that printer without cartridge. So printer would be of no use without the cartridge. Then we have legal value. So undergoing court cases or legal proceeding. So they will have to frame an opinion. The judges would have to frame an opinion on the legal value of a business to determine the case. So in that case, they appoint the valuer and they look outside somebody who have expertise in valuation. So based upon that, they form an opinion that is called legal value. Accounting value or book value, we all understand that is called the carrying value. So typically tangible assets are subject to depreciation and intangible assets are subject to amortization. And we also do impairment, and impairment we have already discussed under Ind AS 36 and 109. Friends, now we understand the fair value. Let us understand what is valuation. So basically it is the process to determine the fair value of an asset or a company. So there are various approaches, broadly three approaches. We will talk about that in our next video. So these approaches would be used to determine the fair value. And then we have the definition of valuation. This is a very nicely drafted definition from International Valuation Standard Council. So it says valuation is a process of determining the economic worth of an asset or a company. So determining the fair value of an asset or a company under the certain assumptions or limiting condition. So there would be some conditions or circumstances under which you would be valuing a company or an asset. As on the valuation date. So again, it says date specific valuation. Valuation is always date specific. It has to be done on a particular date. Circumstances might change after the valuation and its value might go up and down. Then comes the valuation premise. That is also called the basis of doing valuation. So these are broadly 5 valuation premise, highest and the best use as defined under Ind AS 113. So which says you will consider the asset as it's up to its highest and the best use. For example, you have a building and you have not let out that building, so you are not able to fetch any rent from that building. So while doing the valuation, you will consider as if you have let out that building and you will take into account all the notional rent you would have got from the use of that building. So highest and the best available use would be taken into account while valuing any asset or a business. Then we have going concern value. As you all understand that our business will go for foreseeable future, and considering that the future income we will be able to generate, we will take into account that will be going concern valuation. As is where is basis, you might have read in the newspaper. So something is getting disposed of as is on the as is where is basis. Then we have orderly liquidation. In case of orderly liquidation, so the company is undergoing CRP. If they are not able to get the resolution plan, they will go into liquidation. and the liquidator would try to sell the company as a whole, then as a group of assets, and then on the piecemeal basis. So that will be called as an orderly liquidation. Then we have forced transaction. Under the forced transaction, you are not free to trade. You are under a certain obligation, maybe regulatory purpose. You are required to dispose of asset. And friends, I have summed up the valuation premise under this table. So going concern and liquidation broadly, two valuation premise under going concern. It would be value in use, which is used for the financial reporting purpose. Value to a specific holder, that is participant specific value, as we have already seen in that short clip. Value in exchange would be again used in the financial reporting purposes when you are acquiring in case of merger or demerger. So that would be value in exchange. Under liquidation, it would be either forced one or orderly one. If it is a forced one, it would be value to a specific holder, that will be used for legal purpose or investment value. Under orderly one, it would be value in exchange or again to a specific holder. If it is value in exchange, it would be fair market value or fair value of that particular asset, or again it would be participant specific value. Then we have the valuation requirement. Currently, valuation is required for so many purposes, for regulatory purposes, for business restructuring, for reporting, and for miscellaneous other purposes. Under the regulatory, I have listed out only a few. This is not the exhaustive list. Under the draft valuer bill, they have listed out so many. If you go through the draft valuer bill, you will find so many statutes. So government will during the course of time, they will bring in all the statutes under the ambit of valuation. So currently, valuation for regulatory purposes is done under RBI, FEMA, Income Tax, SEBI. And for Companies Act and IBC, only a registered valuer right now can do the valuation. For Income Tax, SEBI and FEMA, RBI, others can also do, chartered accountant, or under if it is under wealth tax. So the engineers can also do. But going forward, you will find that only a registered valuer or associate valuer will be able to do the valuation. Then the valuation would be done under business restructuring. So in case of sale purchase of a business, in case of merger demerger, or in case of raising fund, so valuation is required. Financial reporting purposes, in case of purchase price allocation, portfolio valuation, for fair value reporting, impairment testing, ESOP valuation, again valuation is required. Or there are other purposes in case of undergoing litigation or family settlement, valuation is required. Then we have valuation standards. So basically, valuation standards are generally accepted valuation practices and which developed over the time. So currently, we in India we do not have valuation standard by the government, but however we have valuation standards as per the ICAI. So ICAI, RBO have adopted. Chartered accountant have to follow these standard, but not every valuer have to follow. They can follow the international valuation standard. So ICAI issued following valuation standard, as you can see: 101 definition, 102 talk about valuation basis, which is valuation premise, we already discussed. Then 103 talks about the valuation approaches and method. We will cover that in our next video. Then 201 talk about scope of work analysis and evaluation. 202 talk about report and valuation. We will discuss about that a bit. Then 301 talk about business valuation. 302 intangible assets. Then 303 financial instrument. So financial instrument, you can watch my another video. Then comes friend the valuation process. So there are so many models available across the world for valuing, but author says that valuation is a scientific art. Yet Mr. Damodaran, who is an internationally recognized valuation guru, he says that it is neither a science nor an art, it is a craft. Because he says that broadly, if you talk about the valuation, all the valuation looks similar because there are only three approaches. But if you deep dive into it, you will find each valuation unique in itself. Then comes the process of valuation. First stage, we will have to do the planning. And there is a famous quote which says, if you fail to plan, you are planning to fail. And you will have to do the planning in terms of time required to complete the assignment, your efforts, resources you might be requiring to complete the assignment. Then you will have to gather the information, the background information, so that you are able to complete the assignment with accuracy and with timeliness. So gathering the information does not mean that the gathering information only from the client. It would also involve the information from independent sources or third party sources. Then the documentation is very important. You will have to document each and everything. Then establishing the premise. So basic premise is going concern. In case some client is going into liquidation, so your premise will change. In case of financial reporting purposes, your premise will change. So you will have to identify the premise of valuation also. Then comes identifying the stakeholder. So you will have to identify which all stakeholders are involved, so that the other stakeholder may not file a litigation. So client, who is the client, the counterparty, where the valuation report is required, whether it is required by bank or some government authority. So you will consider all the stakeholders involved on which the valuation will put an impact. So such as employees or shareholders, creditors. Then comes the documenting the finding of the study carried out. So that is very important, because when you are doing the valuation, you will be aware of the circumstances. Maybe 2 years down the line you will forget. So that is very important. You will have to document before forming an opinion. Then arriving at the first stage valuation, once you have collated all your finding, you will have to analyze to arrive at the first stage. So first stage valuation should be based upon your findings. Then comes the evaluating the valuation. So arrive for secondary evidence or empirical testing. So empirical testing involves critical review and evaluation based upon the third party information or based upon your experience. So this is the most important stage, where you have to do the testing thoroughly, so that your valuation is accurate and somebody might not come up with some kind of litigation. Then comes drafting of valuation report. So the report needs to be prepared very carefully, very carefully. It should be drafted, because whatever you have drafted, people outside will read and form an opinion on the basis of your report, not whatever you have discussed or what is in your mind. So you have to draft whatever you want to deliver. You will have to replicate that in your report. Then the finalizing the report by revisiting for completeness and accuracy. I think peer review should be done if you are a team of partners. So if somebody is preparing a report, another partner who is not involved in the preparation or valuation should review that, so that you should not miss out any perspective during the preparation of your report. Now, friends, we understand the valuation process, and we understand the valuation report carries the message to the client. So that should be drafted very carefully, because the valuation report, not just client, all other parties, stakeholders would be reading, and it will depict the competence and the skill and expertise of the valuer. So it should be drafted very carefully. So it should be in a way that it should have an executive summary at the top. So that would give the bird eye view of the entire report along with the result, because your valuation report may run into pages and not everybody will scroll down to find out the result of your valuation report. So you will have to put an executive summary over it, one pager or two pager, with the result of your report. Then assumption, whatever assumption you have taken while carrying out the valuation, you should also mention that. Otherwise, people while interpreting your report may not be able to relate those assumptions which you have taken. So if you do not put the assumption, you will leave the report on the mercy of the reader, may not be able to interpret that correctly. Then comes the deliverable delivered through the report. So that will be presented in a very clear manner along with the scope, engagement letter. So whatever, how the process has been, so you will have to mention that. Then comes the timeline in terms of valuation date, report generation and submission date. So many a times it happens that valuation is done on a particular date and report comes out on a later date. So you will have to specifically mention that particular valuation is as on this date and report is issued as on this particular date. Then the valuation approach, whichever method you have applied, you will have to state that in your valuation report. So broadly, as I said, there are three approach: market, income, and cost. I'll share a separate video on these approaches. Valuation method applied. So whatever method under these approach, if you have applied use the income approach and you have used the discounted cash flow, so you will have to disclose that as well, so that there is a transparency and the professionalism, so that the stakeholder would be able to understand and you would be able to justify your report in the court of law. Then key inputs used in the report, many a times you use the discounted cash flow, required rate of return, tenure of cash flows. So these key inputs, whatever you have used to arrive at the valuation, you should also mention in your report. Then comes the estimate and projection. If you are using the discounted cash flow, you are certainly using the projections, future projections. Then you will have to mention that in your report as well. Then friends, most important thing, which is documentation. Without documentation, you won't be able to substantiate or justify, because if you do a valuation today, people will question after 2 years, after 1 year, and by the time you would have done 20, 50 or 100 valuation and you will forgot what you have done. So documentation is very important. This provides the reference material in case of any on future audits or investigation, you will be able to defend yourself. So broadly, valuation documentation is divided into two parts: internal documentation and external documentation. Internal refers to your working files, your emails you have exchanged, sample you have collected, or documents you have collected during the course of valuation. Whereas the external is the data you have collected from the outside sources to form an opinion. Maybe you have used the comparables, company comparables, or maybe you have used the statutory filings or media report or some kind of government report. So that is external documents. You will have to make a clear documentation of all these. That's all I have, friend, in my video. I will be coming up with a separate video on valuation approaches. So broadly, three approaches. I'll talk about that in detail with examples. So till then, stay tuned and thank you for watching.